CPI yesterday in line with expectations, in line with your expectations as well. 3.7% growth year on year and up by 0.7% month on month for February.
Yes, good morning, Steve. And no big surprises there on the inflation front. And I think it just underpins our view that inflation is going to rise this year, but in a very gradual fashion. And I think when we saw the quarterly bulletin a couple of days ago, we actually saw the Reserve Bank just emphasizing how long it can take for rand movements to actually filter through into the inflation numbers. So given that last year we had a very strong rand, we would expect inflationary pressures to remain fairly contained for the time being. Even though we've had these high oil prices, we're still enjoying the benefits of that lagged currency appreciation. So that is one of the reasons why we still are of the view that the Reserve Bank does not need to hike rates too quickly.
Well, as that MPC winds up today, I suppose it's really the most boring outcome that we're expecting today, because I don't think anybody's expecting a movement in rates in either direction.
Yes, an unchanged decision is widely anticipated. Of course, the market will once again be scrutinizing the details of the accompanying policy statement to see what the Reserve Bank is focusing in on. I think there probably will be some increased reference to oil price developments and the impact thereof. Again, probably referring to what we saw in that quarterly bulletin. And then finally, we'd also be looking to see if there's any more reference to reserve accumulation from the authorities. We know in the past there has been mention of the extent to which the Reserve Bank has accumulated reserves. And if the Reserve Bank drums that beat once again, it probably would be a little bit rand negative. And yeah, all in all, we're not expecting any surprises, but the devil is always in the detail. So we'll be looking at that statement very closely.
How do you think the Reserve Bank's own inflation expectations might have changed from the previous meeting?
Well, oil prices is definitely something to be concerned about when looking at things like inflation expectations. The good news is that probably on the wage front, inflation expectations are going to be curtailed because of the fairly kind of sanguine, subdued inflation environment. But I think the oil price is something that's pushing things up. And administrative prices are probably going to start moderating from the kind of effects that we saw in years gone by. They're going to be sticky, but I think we've probably seen the peak in that regard. So it's really the oil prices that could influence the inflation expectation outlook.
What's the market telling us about interest rate expectations at this stage? Because until about a month ago, there was a feeling that we could have that interest rate hike as early as the third quarter of this year. And that seems to be pushed out a little bit now.
Yeah, look, I think there's still a probability being priced into the market that we could see a 50 basis point rate hike as early as 6 to 8 months. But the market is pretty certain still that we're going to get an interest rate cut of that 50 basis points before the year's out. We don't share that view. We think that they'll probably hold out for the entire year and probably only hike rates in the first quarter of 2012. Of course, there are upside risks to that, and I think the two that come to mind, of course, is the oil price and what happens to the currency. We are expecting the rand to weaken. We're not expecting it to weaken kind of beyond 8 this year. So, you know, even if the rand does weaken, so long as it doesn't blow out, which we don't foresee, then I think, you know, we probably won't see any monetary tightening from the Reserve Bank. And again, partly because of the lagged effect of last year's rand appreciation.
Well, in the meantime, we have had a little bit of rand weakness creeping in from yesterday's best levels. We've got it trading at 6.95 this morning, but the euro really very much on the back foot as well, following the resignation of Portugal's Prime Minister last night.
Yeah, I think once again the market is a little bit spooked about the sovereign debt issues and how that's going to be handled in countries like Portugal. Of course, the sovereign debt issue has really been put onto the back burner ever since sort of the outbreak of the geopolitical tensions in at least North Africa and the Middle East, as well as obviously the tsunami disaster in Japan. But I still think there is room for concern in terms of those debt issues within the European region, and that's why we still believe that the dollar could enjoy somewhat of a recovery in the second quarter of this year, and that of course will feed into our weaker dollar rand view.